What is a margin of safety? A margin of safety is a simple but powerful idea in investing. It means buying something for less than what you believe it's really worth. Think of it as giving yourself breathing space. If you've worked out that a company's shares are worth £10 each, and you buy them at exactly £10, you're relying on your calculation being perfect. But if you buy them for £7 or £8 instead, you've built in a cushion. That cushion is the margin of safety. The concept was made popular by Benjamin Graham, often called the father of value investing, and later championed by Warren Buffett. Their view was that you should never rely on being exactly right. Instead, you assume you might be a little wrong or that life might throw in surprises, and you prepare for that by giving yourself room to maneuver. Why does it matter? Investing, like life, is unpredictable. Even when you do your homework, things can change suddenly. A company might lose an important contract, a new competitor might appear, or global events might shake the market. If you always pay the full price for investments, even small setbacks can turn into losses. By leaving yourself a margin of safety, you protect against those surprises. It's a bit like leaving the house earlier than you strictly need to. If there's no traffic, you arrive in plenty of time. If there is traffic, you're still not late. Or imagine walking across a bridge. Would you feel safer if it was built to hold exactly your weight? Or if it was built to hold 3 times your weight? The extra strength is your margin of safety. It also matters emotionally. Investing can be stressful, but knowing you've bought at a discount helps you stay calm. It reduces the pressure to be perfect, which makes it easier to think long term. In the bigger picture, the margin of safety is really about balancing risk and reward, protecting your downside while still keeping the upside open. Here's a simple example. Imagine you're studying 2 companies. For both, you've estimated that a fair value for their shares is £10. Company A's shares are trading on the market at exactly £10, while Company B's shares are trading at £7. If you buy shares in Company A, you need your estimate to be correct. Any mistake leaves you with little or no profit. But with Company B, you've given yourself a £3 margin of safety. Even if your estimate was slightly optimistic and the true value is closer to £9, you've still bought below that, which means you're less exposed to loss. This isn't only an investing idea, it's something you can see in everyday life. Imagine you've budgeted £200 for a weekend trip, but you only end up spending £150. That £50 gap is a kind of margin of safety. It gives you peace of mind and flexibility in case of unexpected costs, like a last-minute taxi or a surprise meal out. What else should you know? A margin of safety doesn't mean you can't go wrong. If your judgment of value is completely off, a discount won't protect you. Buying a share for £7 sounds good, but if the company is really worth only £2, you've still made a bad investment. It also takes patience because the market doesn't always offer clear bargains, and you might have to wait a long time before prices fall into your comfort zone. There's also the danger of being too strict. If you demand an unrealistically huge margin, like only buying something worth £10 when it drops to £3, you might never invest at all. On the other hand, ignoring the idea altogether leaves you much more vulnerable to losses. The key is balance, not being careless, but also not being so cautious that you freeze. The stronger your research, the more meaningful your margin becomes. And one important misconception to clear up, a margin of safety doesn't guarantee profit. It only improves the odds in your favour. Think of it less like a winning lottery ticket and more like wearing a seatbelt. It doesn't prevent accidents, but it makes you safer if one happens. To sum it all up, the margin of safety is your built-in cushion. It's the difference between what you believe something is worth and the lower price you actually pay. It won't make you invincible, but it does make you better prepared for mistakes, setbacks, and surprises. At its heart, it's about reducing risk, balancing risk and reward, and giving yourself room to be human in a world that rarely goes exactly to plan. If there's one practical takeaway, it's this. Don't aim to be perfectly right. Aim to give yourself enough space to be a little wrong. That's what the margin of safety is really about. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description. Don't miss out.